Okay. Good evening, distinguished professional, professional colleagues, and welcome to another edition, or welcome to Next Gen Professional Associates. For those who are just joining us for the first time, I am Ibrahim Akindele, and I will be taking you 70% of strategic financial management. Right. So in today's class, we shall move to another subtopic under, we are still in cost of capital, but this part of cost of capital is different from the first part of cost of capital. Class, please pay attention. All right. This part of cost of capital is kind of different from the first part, the first one that we actually did in class. Right? Right. The first one that we actually did in class. So, class, this is another part of cost of capital, and you must understand it because this is what you will use to discount the project. Now, we should not equally forget how we move to cost of capital. What leads us to cost of capital is the function of a financial manager. All right. One of the function of the financial manager, or the function of the financial manager are the investment decision, the financing decision, dividend decision. So you've identified an investment that is viable. Fine. This investment is viable. The next question you should ask yourself, how will you finance this project? Right? And that is what takes us to cost of capital, which is what the sources of finance. Right. Now, we have these sources of finance. What do we use this cost of capital for? We use it usually to discount your project. When we are done with cost of capital, we will now move to investment appraisal. Then you will now use that cost that you calculate, use it to discount the project. We'll get there. Now, what I'm trying to explain here is that this second part of strategic financial management is kind of different from the first part. So please pay attention, please. Now, risk-adjusted cost of capital or project-specific cost of capital or appropriate costs of capital. Class, sometimes the examiner will ask you, the question will say, oh, calculate appropriate cost of capital or project specific cost of capital or risk adjusted cost of capital. Class, what did they use these terms for? Now, this project specific cost of capital or appropriate cost of capital, it is usually used, right, when a company is diversifying. Class, please pay attention. When a company is diversifying, when there is what? Diversification. A practical illustration, how you will figure that out in the question. A practical illustration is when Wale PLC is producing rice. Then Wale PLC now say, oh, because I want to diversify, because I want to expand my business operation, but I want to diversify, right? I want to diversify. Oh, Wale now say, oh, because of this economic downturn, okay, I'm moving now to cement industry. That is diversification. So usually, so the question is, what will you now use to discount the project? It is project specific cost of capital or appropriate cost of capital, because you need to, that diversification needs to include what we call risk. We'll get there. Now, what I'm trying to explain here is that when a company wants to diversify, When you just see it in the question, required, calculate project specific cost of capital, something should just come to your mind first. Oh, the company is diversifying, or the company wants to diversify. There is diversification here. Even without reading the question, you already know that, yes, the company wants to diversify. Probably they are producing cement and they want to go into the production of what? Beans. That is diversification, right? Now, if you are producing rice and you want to go into the production of cement, right? There are some risks that the company will take. Now, let me quickly go to the definition of terms. What is, let me start from asset beta, right? Asset what? Asset beta. The question is, what is asset beta? Class, do we get my definition of project specific cost of capital? Diversification. Class.
Yes, sir.
Yes, yes.
Oh, okay, that's fine. Asset beta. The question now is, what is asset beta? Asset beta measures business risk. We should not equally forget that in our previous lecture, it seems that I explained business risk. Class, this business risk, financial risk, this systematic, this risk, or no, this risk. Class, that is, you will see it as, you may see it as 4 marks, 2 marks, 3 marks, and it's part of it. So please pay attention. Asset beta measures business risk. Class, asset beta measures what? Business risk. The question now is, what is business risk? Business risk is the risk that affects a particular line of a business. A typical example of business risk: the financial institution are faced with CBN recapitalization last year, which they are to meet up with this on or before I think 31st of March or January. I think January or March, they need to meet up with the CBN recapitalization policy. Now, any bank, any financial institution that will not meet up with that, they may sanction them or give them or anything, right? So it is one particular risk that is affecting them. Another part, that is business risk. A practical illustration is maybe an agricultural company, right, who is producing bandits and some other insecurity. We affect such line of a business. That is business risk. That is what? Business risk. Asset beta measures business risk. Now, what is equity beta? Now, equity beta measures both the business risk and the financial risk. Class, asset beta measures business risk, a risk that affects a particular line of a business, right? While equity beta measures, right, the business risk and the what? And the financial risk. What is financial risk? It's a risk that affects an individual company, that affects a company not to what? Achieve their what? Achieve their objective. Class, if a company is unable to pay their debtor or their creditor, sorry, as and when due, they are facing financial risk. If the company level of gearing is actually high, they are facing financial risk. Class, so in this case now, the financial risk is just the financial risk that is affecting Wale PLC will be different from the one that is affecting Abiodun PLC. It is just an individual company, not general. Unlike systematic work, unlike business risk, that is affecting that one line of a business, everybody in that line of a business. While financial risk is only the risk that affects individual, you alone, not general. Now, excuse me. Now, what bring about this explanation is because Wale PLC is producing beans. Why Abiodun, Wale PLC is producing beans, and Wale want to go into the production of cement or into manufacturing of cement. Now, Wale need to consider the risk that is affecting that line of a business, which is cement industry. Need to consider that risk, right? That is why they will say, oh, calculate risk adjusted cost. So you need to calculate, you need to know what are the risks that affect that line of a business. And that is what we call business risk that is affecting that line. That is the reason why you will see in my definition of asset beta, I say asset beta measures systematic risk. So while you need to look at it that, oh, what are the risks that is affecting the manufacturing sector? That is systematic what? That is a business what? Business risk. Sorry, systematic risk. Systematic risk is unavoidable risk that affects everybody, not a particular line of a business. So that affects, it is what we call unavoidable risk, systematic risk. It affects everybody. A typical example is, a practical illustration is the inflation rate. It's affecting everybody. The exchange rate is affecting unemployment rate is affecting everybody. That is systematic risk, right? Why a business risk is one line of a business, right? For instance, Wale is producing cement, and Wale want to diversify into the production of or manufacturing of diapa, right? Now, what are the risks that this manufacturing industry that are in that industry, what are they facing? That is what we call business risk. So that is the reason why you need to determine the appropriate cost of capital that you will use to discount the project. Your cost of capital need to include the risk because of what you are diversified into another line of a what? Another line of a business. Class, am I communicating, please? Am I communicating?
Yes, sir.
Okay. Now, what are the steps? Let's say the question says that, states that calculate the appropriate cost of capital or the risk adjusted cost of capital that will be used to discount the project. Please don't forget, once you in the required, you see appropriate cost of capital from the required or project specific cost of capital, it means that in that question there is diversification. It means that it could be that they are into one line of a business and they want to diversify, right? They want to diversify. Now, what are the steps in calculating either the project specific cost of capital or appropriate cost of capital, depend on the name, or the risk adjusted cost of capital? These are the terms you will see in the what? In the requirement. The first thing you should do that should come to your mind is, first, identify the proxy company. The proxy company. Class, what is proxy company? Busayo PLC is into production of rice. Then Busayo now say, oh, I want to diversify into another line of a business, probably production of manufacturing of cement in another sector. Busayo PLC need to consider the business risk that is affecting that sector. At the same time, Busayo PLC will now identify a similar company that has been in the production of a cement for years and identify them as what we call proxy company. Is the company you are diversifying into, the company, right? The company you are diversifying into, the other line in the other line of a business. That is what we call proxy company. Class, are you still with me? Are we still together?
Yes, sir.
Now, that is proxy company. So, from the question, you need to identify the proxy company, which means the company you are diversifying into, the other line of a business. You are producing cement and you want to go into the manufacturing of what? Maybe beans, right? Then you need to identify similar company that has been in that line of a business. And that company is what we call proxy company. From the question, you will see it that AA Limited is this, and they have identified a similar company is this. So that similar company is what we call proxy company. Now, number 2 step is either you de-gear or on-gear by removing the financial risk of the proxy company. That is, calculate asset beta. Class, when you are removing the financial risk of the proxy company, of the company you are diversifying into, the other line of a business, right? Then you are left with, they say calculate asset beta, and asset beta measures business risk. So when you remove the financial risk, because you don't need the financial risk of that company you are of that proxy company. You don't need it because it is only affecting that company alone. So when you remove the financial risk, then you will now left with what? The business risk, which means the business risk that is affecting that line of a business. That is all you need because you want to diversify, and that is calculate asset beta. Now, asset beta is calculated BA equals to BE, right? BE times VE divided by VE plus VD 1 minus T plus BD times VD 1 minus T, VE plus VD 1 minus T. Now let me define the term where BA is equals to asset beta, BE equals to equity beta, VE means market value of equity, right? Market value of what? Equity, which is what? VE. VD means market value of debt. Then T means the tax rate. Now, all this information are for the proxy company. By removing the financial risk of the proxy company, all this information will be for the proxy company, the company you are diversifying into the line of a business. All this information will be from the information given to you for the what? For the proxy company. That is why they say remove the financial risk of that proxy company. We don't need it. I don't need your financial risk because it's only affecting you only. It's not affecting the line of a business. And if you remove the financial risk, you are left with what we call business risk. And that is why I say calculate asset beta. Now, in a situation whereby when beta debt is equals to 0, that is this part here is equal to 0, right? Automatically all these things here will be 0. So therefore, your asset beta will be equals to BE times VE, VE plus VD, and 1 minus what? 1 minus tax rates. BD means beta debt. If the beta debt of the proxy company is given as 0, or if it is not given at all, that is 0. So you don't have any business with this, any business with all this information, because if you put 0 here, everything here will become 0. That is why I say, okay, when the beta debt of the proxy company, all this information are for the proxy company. When the beta debt is equal to 0, or is not even given in the question, so you don't need to stress yourself. Everything here will be automatically be what? 0. So therefore, the BA equals to VE, BE times VE, then VE plus VD, 1 minus tax rate. All this information are for the what? The proxy company. Now, there is always a little challenge here, just little challenge, just right, small challenge like that. Now, and what is it? So how do we determine the market value of equity? Class, you should not forget from the normal cost of, from the cost of capital, we know how to determine the value of equity. Is that not so, class? Market value of equity, right, class? Hello?
Yes, sir.
Am I the only one in this class?
No, sir.
Okay.
Yeah,
We know how to
sir.
determine. Okay, we know how to determine the market value of equity, the market value of debt. Now, in another case scenario, if your market value, if your market value of equity, if you will not use that method to calculate market value of equity and market value of debt, right? There is this percentage that usually you will see from the in the question. Let's say debt, you will see something like this. Debt, they will tell you that the market value of debt to equity is equals to maybe 60%. They will tell you that in the question that the market value of debt to equity is equals to 60%. You can see that it is not given in a value, it is given in what? In percentage. Fine. Now, meaning that your debt, what it means is that market value of debt, which is VD, will be 60, right? Why? The market value of equity will be what? Will be 100. That is what it means. If it is given in the question that the market value of debt to equity is equal to 60% or 0.5 or 0.0 or 0.5, right? That is 50% or 60%. It means that the value of debt is equals to 60 and the value of equity equals to what? Equals to 100. Class, in another case scenario, you may still have debt over debt. Use small letter. Debt divided by debt, which is the level of gearing. Don't forget that all this is what we call the level of gearing, right? Solvency ratio, where you have debt over equity. Is that not so? Now, when you have in a situation whereby in the question you have the market value of debt divided by debt plus equity equals to, let's say, equals to 50%. So the question is, what will be your value? What will be your market value of debt? And what will be your market value of equity? So therefore, when you have something like this, so VD, market value of debt, will be equals to 50%, right? Then the value of equity, right? The value of equity will be 50% as well, meaning that your debt is 50 divided by 50, which is the debt. Okay, let me use 60. Okay, 60. Then the value of equity will be 40. So this will be plus 40. So that is what it means, class. So these are the case scenario you may see in question, right? These are the case scenario. Debt to equity equals to the market value of the deposit company. Debt to equity is 60%, meaning that value of debt is 60. The market value of equity will be 100. So in a situation whereby you have debt divided by debt to equity is equals to 60, right? So therefore, the value of debt will be 60, right? The balance, because you have debt divided by debt to equity, so that you have 100 class. So therefore, the value of debt will be 60, the value of equity will be 40. Now, in another case scenario, right, in the question, whereby you have debt to assets, these are the language you will see, these are the terms you will see. So now, in a situation whereby you have debt to assets is equals to 60, it's just like the first one. It means that it is debt to equity, meaning that the value of debt is 60 and the value of equity is 100. And this is how you will use to determine your market value of debt and your market value of equity. If it is not given in what? In value, right? If it is in percentage, you use it like this. If it is in value, sometimes you need to determine the market value of equity, which we already know, right? How to determine the market value of what? Of equity. Now, if this is established, we move to another step, which is step 3, right? We move to step 3. Regear by including the financial risk of the main company. Class, leave English of regear. By including the financial risk, you should include the financial risk of the main company. Class, don't forget that there are two companies, the main company as well as the proxy company. The main company is Busola PLC, who is manufacturing cement, and Busola PLC want to diversify into the production of phone, or into the manufacturing of phone, or into manufacturing of beans, or into production of beans. Is that not so? Now, by doing that, Busola PLC is the main company. Now, you need to identify similar company in that area that you want to diversify into. That company that you identify is what we call a proxy company. Now, don't forget that when we are calculating the asset beta, we have removed the financial risk of that proxy company because we don't need it. The only thing that we need is the business risk, right? Now, in step 3, now include the financial risk of the of the main company. That is, calculate equity beta, meaning that equity beta include the business risk of the proxy company plus the financial risk of the main company. That will give you what we call equity better. Now, what it means is that, in simple terms, what it means is that you are diversifying into another line of a business, right? What are the risks involved in that line of a business? That is what we call business risk. Fine. In your own company, in your own, right, which is the main company, there are some financial risk you are facing as well, right? So therefore, if you are going into another line of a business, you need to have the financial risk of your main company plus the business risk of the other company. That is calculate what equity better. Now, with this now, BA, what you calculate here as BA as the what asset beta class. Can you see asset beta? Now, from this part here, from this, right? From BD, which is beta debt, the value of debt, 1 minus tax rate, and the VE, right? Are for what? For the main company. These are the financial risk of the main company. Now, you are coming in to add asset beta, which is the business risk, right? Of the what? Of the project company. Can you see? That is why you have business risk and the financial risk. That is, calculate what? Equity beta. So this place here, from this part here, is for the main company. So you identify the beta debt of the main company, the market value of debt of the main company, the tax of the main company, the value of equity of the main company. Saying you now had it with the what? With the business risk of the project company, which is what? The BA. Class, am I communicating, please? Hello, class.
Yes, sir.
Okay.
Hello, we are adding it or we are subtracting it, sir?
Anyone that you see, following show, you see BA plus BA minus BD. My explanation is just showing that you are including business risks. Where you add, where you subtract. Do you get?
Okay.
Now, the next step, calculate the cost of equity. Calculate the cost of equity. With that, can you see that when you calculate the equity beta, you have include the business risk and the financial risk, and that is why it is usually called risk-adjusted cost of capital, because you will add the business risk of the project company and the financial risk of the main company. That is why the question will say, oh, calculate appropriate cost of capital or risk-adjusted cost of capital or specific or project specific cost of capital. You should know that, oh, this company is what? Is diversifying. Now, calculate the cost of equity using what? The CAPM. Can you see there's one question at the beginning when we ask, I think in the process, the question says, okay, explain how project specific cost of capital will be used to determine cost of equity. Yes, cost of equity. These are the process. You can see how we started. We started from asset beta, from asset beta to equity beta, from equity beta now calculate what? CAPM. You can see, you can state the steps, and these are the steps. In stating the steps, you can now explain the financial risk, the business risk, the systematic risk, and unsystematic what? Risk. Right? Don't forget that systematic risk is unavoidable. Why unsystematic risk is what? It can be what? Avoided. Right? It can be what? It can be avoided. Now, calculate the cost of equity. Now, this cost of equity using CAPM, that cost of equity has include risk. Has include what? Risk, both the business risk as well as what? The financial risk. Now, it is calculated as RF plus BE, equity beta, right? What you calculate here as equity beta, you bring it here as your equity beta, then the market return, which is RM, minus what? Risk-free. In another case, when you have risk premium, so it will be RF plus equity beta times risk premium, right? So that is because in some question, the question may not, sometimes question will not say, oh, determine appropriate cost of capital. When the question say determine appropriate cost of capital, but in another case scenario, the question may say, oh, state that calculate the cost of risk, use a project specific cost of capital to determine the cost of equity. So in that case, you will just pause in step 4. You just pause. You will not continue. But if you still want to continue, maybe you want to show your skill, fine. You can calculate the weighted average cost of capital, right? Now, this weighted average cost of capital, which is step 5, it includes the risk. And that is why the question will state that prepare or calculate a project specific cost. You know, when I say project specific cost of capital, it includes both equity and what? And debt. You can see this method of calculating WACC. I know it may bring some kind of issue. Why did you use this second method? Anyone that you want to use. If you want to use Ashtuta, go ahead and use Ashtuta. If you want to use this part, which is calculate the weighted average cost of capital, value of equity, multiply your value of equity times the cost of equity. Value of equity plus value of debt. That is what we did. This will give us the total market value. Is that not so? Now, the value of debt plus cost of debt. Now, cost of debt, why did I use 1 minus 1? You know, cost of debt, there is always a tax relief on debt. So in a question, if the question states that, oh, the debt, okay, the cost of debt, you have, if the question states that, oh, you have pre-tax cost of debt, pre-tax cost of debt of 6%, that means that they have not take consideration of what? Of tax. It is pre, which means that you need to do 1 minus the what? The tax rate. But if in the question you now see that, oh, after tax cost of debt, so you don't need to include, you don't need to say, oh, 1 minus tax rate, because tax has been taken into what? Consideration. Class, am I communicating? And this is what the weighted average cost, which is called the risk adjusted cost of capital, that you will use to discount the project, of which we'll get to when we get to investment appraisal, right? So class, are we still together?
Yes.
Yes, sir.
That's fine. Please, you can ask your question. Please ask your question before we move. Right? You can ask your question. You must understand these 5 steps. Don't forget that in calculating your weighted average cost of capital, this is for the main company. Everything that you are calculating here is for main company. This weighted average cost of the value of equity of the main company, the cost of equity of the main company, value of equity of the main company, value of debt of the main company, and tax of the main company. So if you have question, you can mute your mic and ask your question. Let me just give seconds, right? So ask question now. Question time. Are we good? Okay.
Sir,
If we are good with this.
I have a question.
Okay.
Sir. This.
Okay, please go ahead.
This step 4, it says calculate the cost of equity using CAPM. Is it a must? We must use CAPM? Is it possible that we could see a question that we should use a dividend valuation method?
Value. Do you know the reason why you must use CAPM? It can never be dividend valuation. It can never be dividend. Do you know why? Because you need that equity beta that you calculate that include business risk and financial risk to determine the cost. Is because of the risk. That is the reason why it is called risk adjusted or appropriate cost of capital. So the dividend valuation method does not include any risk now. So how will you now include that equity beta in your calculation. So that is why I say these are the 5 steps. You get?
Yes, sir. Thank you, sir. It makes sense.
Yeah, thank you. Welcome. Question time. Okay, that's fine. Okay, let's quickly look at illustration. Right. Question on risk-adjusted cost of capital, appropriate cost of capital, or project-specific cost of capital. Question 1. Please, can someone read for us? Who will read, please?
Okay. APLC is evaluating the viability of a new project in a different industry.
Okay.
BPLC operates in the same industry as a new project. You have the
Hold on,
following.
sir. Hold on, sir. Thank you. Now, you can see that APLC is evaluating the viability of a new project that is different from the one they have before, a new project in a different industry. And BPLC operates in the same industry as the new project. So the BPLC, right, is the what? Is the project company. APLC is the main company because it is a new project that is different from the industry. And they need to identify a similar company that are into the new, based on the new project. And thank you, Afolonsho. And BPLC operates in the same industry as the what? As the new project. You have the following information, additional information. Equity Beta, APLC, BPLC. Please, we should not forget that the first thing we need to do is to read the requirements, the required. Class, when you read the required of every question, you understand the requirement, it is assumed that you've solved the 60% of the question. Now let's quickly go back to the requirement. Calculate showing all relevant workings, the appropriate value of beta to be used in computing cost of equity for the new project. The appropriate value of beta. So what it means is that you don't need to calculate your weighted average cost of capital. No, the question did not say that. Calculate the appropriate value of that beta that you will use to determine the cost of equity. Calculate it. Class, calculate it. That's beta. And what is the beta? It is the equity beta, because you have to bring in the equity beta here and put it here before you can use it to determine your cost of equity. Can you see? The beta that you will use to determine the cost of what? Of equity, or for the what? For the new project. Equity beta, APLC, BPLC. You can see that we have debt to equity. The book value is useless because you don't need book value. What you need is market value, right? Debt to equity ratio, which means that market value, can you see that debt to equity ratio, market value, book value, market value, APLC, this is 20, right? 20%, meaning that you can see that it is debt to equity, meaning that debt is 20 to equity, then equity is what? Is 100. Market value of debt will be 20. then equity will be what? Will be 100. At the same time, when you have here 1, what will give you 1? Is it not 100 divided by 100? That is 1. So, meaning that debt will be 100, equity will be 100. Or debt is 1, equity is 1. Fine. Right, class? Because this is 0.20. They've converted it. Right? This will give you what? 20%. Equally, they've done the same thing with this. Right? This is 100%. This 1. 100 divided by 100 is 1. Class. So therefore, the market value of debt is 100. The market value of equity is 100. The tax rate 30%. Class, we don't need book value here. Right? Because from our formula did not indicate any book value. So what is the first step? Suggested solution. Suggested solution. Step 1. What is the first step, class? What is the first step?
The deposit company.
What is the deposit company here?
BPLC.
BPLC. That is the deposit company. What is the next step?
We ungear
the proxy company.
By including the what?
The
The
asset
financial risk. Right? By removing the financial risk of the deposit company, that is, calculate the asset
better.
So I can copy this as part of this step 2. I'm going to calculate the asset beta. Right? Now, in calculating my asset beta, which is BA, I need to define the term, right? BE. Don't forget that all this information are for the what? The proxy company. All this information here are for the proxy company. Now, we need to identify the BE of the proxy company, the VE of the proxy company, right? So therefore, market value of VE, market value of equity, or we can start with BE. Equity beta. What is the equity beta of the proxy company, class? What is the equity beta of the proxy company?
1.9.
1.9.
1.9. So after that, we need to the value of equity of the proxy, the value of debt of the proxy, the tax of the proxy, better debt. Do we have better debt in this question? Let's check. Are we given better debt of the proxy company? No. So therefore, we don't need this part. Here we become 0. Right? We don't need this. Right? Meaning that we don't need this part of the formula. Okay, let me just. Right. So we don't need it. So we just copy the other one, right? The first part of the formula, because better debt is equals to 0, right? Because better debt of the proxy company is not given. So therefore, right? Now, the value of what is the tax rate of the proxy company? Tax rate of the proxy company is what? 30%. 30%. Now, if you want to determine the value of equity and your value of debt, that is the level of gearing. Can you see it? Debt to equity. Market value, not book value, please. Now, you cannot use the level of gearing given to you in the question. Debt to equity, right? That is equals to, debt to equity is equals to how many percent? 20%. Class. This is the 20%. 20%. So if this is 20% equals to, meaning that your debt is 20, your equity is 100, meaning that market value of debt is 20, then the market value of equity is 100. So we can have 20 and what? And 100. Class. So all the ingredients, we are good to go now. So therefore, asset beta, BE, is 1.9. Value of equity is 20. Value of debt is 100. Value of equity is 20. Then the tax 0.3. Class, what is the asset beta, please? What is the asset beta? What is the asset beta, please? What is asset beta? Figure, please. Hello?
I think it's 0, sir.
But sir, I thought we were
How can it
looking
be
at
zero?
that of BPLC.
Yes. Yes. Oh, where did we pick 20%? Oh, sorry. Oh, sorry. BPLC, thank you. Thank you. This should be 100% because it is 1. 100 divided by 100 is 1, right? They've converted it already. So this will be 100. The market value of debt will be 100. While the market value of equity will be 100. Thank you. So this will be 100. So we can have 100. 100. So what do we have? Class, what do we have? What do we have? Away.
11%.
Where did you see 11%? Away. Is it 11%? Please, who will give me figure now? I beg. Oga Adekunle, right? It will not be in percentage. I said better will not be in percentage.
1.12.
Okay, thank you. 1.12. It will not be in percentage, please. Okay? Please. Thank you. Now, this is what the asset beta. This asset beta is the business risk of that project company, that line of a business, that new project. All right. The next step is to regear by including the financial risk of the main company. We should not forget that the question says calculate the appropriate value of beta. That beta that we will use to determine the cost of equity. Is that Esther, please mute your mic. So that's beta that you use to calculate the cost of equity. Can you see? You need beta here. That beta, this beta, that is what they say you should calculate, right? That you will use to determine the cost of equity. This beta, and this is it here, that will be used to determine the cost of equity. So the next step, step 3, we have to include the financial risk of the main company. Your assets beta, the asset beta is the business risk, right? Step 3, right? Now, you should not forget that this is for the proxy, and all this is for the what? For the main company, for the main company class. Now, BA is equals to 1.12, right? BA is equals to 1.12. BD, which is the beta debt. Now, in the question, are we given any beta debt of the main company? Any beta debt of the main company? No. Can you see? There is no beta debt. Right? If there is, it would have been mentioned like this equity beta. They will state it beta debt. No. Right? No. So the beta debt will be equals to 0. So the value of debt, for you to calculate the value of debt, we're given the market value of debt, we're given the level of gearing, right? We still apply it here as well. So the gearing is debt to equity. So debt to equity is equals to what? Can you see? Debt to equity, that is 20% class. 20%, 0.20. That is 20% equals to debt is 20, then equity is 100. So therefore, market value of debt is 20, then the market value of equity is 100. Don't forget, you can see that all this is for the main company, for the main company class. The financial risk, these are all the financial risk of the main company, and this is the business risk of the proxy company, the industry you are diversifying into, right? So therefore, the tax, I guess, is the same tax rate, 30%. 30%, right? So we can insert it in our formula. BA equals to BA. BA is 1.112. 1.112 beta debt. Value of debt is 20. Tax 0.3. Value of equity is 100. Plus, what do we have? BE is equals to 1.112 plus, this is 0. So what do we have here? 20 times, open bracket, 1 minus 0.3 divided by 100. Class, what do you have?
0.14.
0.14. When you add it together, what is your equity beta? Class, what is the equity beta?
1.28.
1.28. This is the equity beta that you will use to determine the CAPM. And that is what the question says, right? Appropriate value of beta to be used in computing the cost of equity for the new project. So we need to stop here, right? Since the question just say, oh, the beta that you will use to determine the cost of equity. Don't forget that the next step is to determine the cost of equity. And this is the beta that you will use to determine the cost of. You can see that the requirement of question is very important, right? The requirement is what is very, very important. So do we have anyone that have question? Question, please. Okay.
Yes, sir. I actually have a question, and that I'm having issues with how you were able to um for calculating this debt to equity. How you got the 20 over 100? I know they gave us the question, but how do we how are we sure? Like, how are we going to you know which one is debt, which one is equity?
Are you, when we started this, were you in class?
I actually joined late, sir.
Yeah, so that's why. So you have to go back. You have to go back and watch the video again. Do you get?
Okay,
Thank
sir.
you. Thank you. Please, any other question?
Hello, sir.
Sir?
Hello, sir.
Yeah, go ahead, please.
I'm still confused about the identification of this formula. Which one is for the proxy and which one is for the main company? Is it
Were
the
you in
one
class? Were
highlighted?
you, sorry, sir. Were you in class when we start this class? Were you in class?
The one of today?
Yes.
I was in class.
When we start from the beginning.
Yes, yes. What I'm trying to say is that here in this formula, you highlighted it.
I've explained
The
it.
demarcation.
Go ahead, please.
Hello?
Go ahead.
The demarcation, there is bracket in this formula. From the minus sign to the right, is it part of the main company?
This is for them. That is why I highlighted it like this, that this is for the main company, right? This is the financial risk we are talking about. That is why they say including the financial risk. Stop. I'm not just bringing the formula for everyone to cram. I'm bringing the formula to understand the formula, why we have to do it that way, including the financial risk. So this part here, the right hand side, this part here, right, that is not highlighted, you can see it. This is for the main company, which is the financial risk. This is BA, the asset beta, which is what? The business risk. Do you understand now?
Okay.
Do you understand now? Okay. Please, any other question? 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 Okay. I think we have to stop here, right? Continuing our next class. I still have small things. Okay. That's we'll continue from here in our next class. All right. So please go back and please watch the video. The material is not available. I need to add some questions to it. I have some new questions. Right. I have to add some new questions to the project specific cost of capital. I think I have about 5 questions like that to add. So maybe make it 7 questions. So please, you have to go back and watch the video. Check the playlist now. Immediately after the class, just check the playlist. You will see the project specific cost of capital parts 1, right? Maybe after our next class, right, the material will be available. So thank you so much. Do we have anyone that have questions before we go quickly? Okay. Thank you so much, everyone.
Yeah.
Go ahead.
Okay, yeah. So now for this question, apologies for taking us back, but is there any question that they can ask further apart from this place that we stopped? What could be
This
possibly
is just the first case.
Okay.
This is just the first case scenario. I have so many questions. We will explore.
All right. It's okay.
So thank you so much, everyone, for joining. And don't forget, I know some professional students are still waiting. They are still thinking, am I going to write SFM or not? Okay, whether you shift it to next diet or open diet or any diet, you will still write SFM. Now, the best thing is for all the professional students to do what? Face it now. And guess what? There is nothing in this SFM if you follow the principle and go back to it again. You have to go back and check. Make sure you understand. Don't cram. Make sure you understand. Right? If I cram all these things, I will not be able to tell you that, practical illustration, this is how it is. This is how it is. I'll just come and tell you, this is the way it is. And that is all. You take it like that, we'll move. Is that not so? So please stay away from people that have negative energy. They will tell you SFM is difficult. This is that. Right? If Mr. A can pass SFM, you can also pass SFM now. Is that not so? So you have to start reading now, class. Grace does not work in an isolation. You can't sit down and be saying, I want to pass SFM. I want to pass case study. I want to pass this without effort. It is not possible. It is not. Grace does not work in isolation. You cannot just sit down and say you want to pass it. You have to add effort to it. You can see that as you are preparing for the exam, I'm also preparing because I'm not sleeping, you are not sleeping. Can you see it? So imagine someone that is not even writing the exam, right? He's doing research, bringing in, thinking of, okay, this is how we should do things, right? And someone will be in that platform saying that, me, I never started to read. Okay, and time is going, right? So please, we need to take the challenge now, right? So if you have any question, you can drop it in the platform. So thank you so much, everyone, for joining, and enjoy the rest of your evening. Thank you. Bye for now.
You're welcome, sir. Thank you, sir.
Thank you.